Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
Well, the moment of truth for Apple's AI plans and for the $471 billion rally that has rescued the stock from the doldrums. We've talked about AI being a central focus of the WWDC. Kicked off at 1 p.m. Wall Street time today. We've been giving you updates throughout the day on that partnership with OpenAI and everything that Apple has thus far announced. We'll continue to bring those updates as we do get them throughout the week. But first, let's talk about the stock reaction, because Ryan Vlastelica is Bloomberg News equities reporter. He writes all about what's at stake with Apple and AI. Shares of Apple down by 1.8% right now. Ryan joins us from the Home Bureau in Chicago. Ryan, give us what's at stake right now for Apple, given that, yes, it's significantly underperforming the S&P 500 and the NASDAQ 100 right now. But we've seen a rally over the last month that has investors looking pretty optimistic.
Yeah, absolutely. So the context I would say is that Apple is really facing two key concerns. One was that it just wasn't growing all that much. I think 5 of the past 6 quarters, it saw negative revenue growth. And a lot of the other names in tech have been showing, pretty robust growth. And a lot of that is due to AI, which is an area where it felt like Apple was a little bit behind the curve. It didn't really have a very articulated AI strategy. People were really hoping that today would really address both of those, that it would announce all these kinds of new AI features, especially for the iPhone, and then that would spur people to, begin upgrading their phones, and that would spur, a new leg of revenue growth for the stock. So it did come out. It wasn't anything I think that was too surprising as far as the new features, as far as the new, applications and the way that it all is being integrated across the ecosystem. But I think right now we're seeing just a little bit of a pullback, not incredibly dramatic given how much it's been going up ahead of it, but it does seem like, as far as addressing, will this be enough for people to, trade in and spend, more than $1,000 in a new phone?
That's what we wanted to get with you. And we've been getting into some of the fundamentals off of the event on the West Coast around Apple. But Ryan, when you look at the share price and the bounce back that we have had, as we note, this $471 billion rally off of the lows, that we've seen in Apple, that's, even though the stock is little change, it's had quite a bounce back. How much of, or what is that enthusiasm or that bounce back reflect? And as you said, Apple shares a little bit lower, but maybe not such a big deal considering the bounce back we've had.
Yeah, so one thing I would say is that early in May, it had its latest quarterly report, and that was pretty encouraging. The forecast was seen as pretty encouraging, pointing to a return to growth, kind of eased some concerns about the state of sales out of China, which is a incredibly important market for them. And there has been a lot of optimism about AI. And of course, in that quarterly report, Apple did announce the largest stock buyback program in U.S. history, $110 billion. I think that is helping to put a floor under the stock, if nothing else, and certainly if you look at Apple on a valuation basis, especially with respect to the growth, it might screen as, somewhat pricey. But if you look at it as far as all the quality characteristics with respect to the buyback, with respect to cash flow, profitability, all that kind of stuff, it does screen as pretty, screens pretty strong on those. So I think that's also, Jen, there is sort of a view that Apple is a safe haven, and maybe it's not as pronounced as it was in past times when growth was a little bit more robust, but certainly it's part of it here.
All right, Apple shares down 1.8%. Ryan Vlastelica, Bloomberg News equities reporter, joining us there in Chicago. We're going to stay with Apple.
Let's bring in Bloomberg News chief technology correspondent Mark Gurman, who joins us from LA. Mark, Tim Cook has wrapped up his comments. They began, the WWDC kicked off, I should say, at 1 p.m. Wall Street time, so it's been a couple hours. Biggest headlines so far, give them to us.
The biggest headline is probably that OpenAI partnership that we have been talking about for several months.
I knew that because you told us about it, Mark.
Yes,
ahead of time.
Yes, that was probably the highlight. But obviously, that's part of the larger AI strategy, which is Apple Intelligence, as we also talked about. Now, the way they explain Apple Intelligence is AI for the rest of us, right? That harkens back to the old school Apple line, which is a computer for the rest of us, right? And so this is a more friendly approach to AI. This is AI integrated deeply inside of applications, things like summarizing notifications, writing tools, image editing, a much improved version of Siri. So the AI was the focus of the event. The other stuff sort of took, was pushed onto the back burner. They started off by talking about more customizable home screen on the iPhone and iPad, some new gesture controls to operate the Vision Pro. But of course, the highlights were, of course, the experience coming for AI to the iPhone, the iPad, and the Mac. And so it's going to be quite significant for Apple. It's very clear to me that they're starting off pretty slow here, and they're going to expand over time.
Couple questions. So AI for the rest of us, marketing or innovation in your view?
Well, it's marketing based on what they have available to them, right? This is as far as they could take their AI feature set for the time being, and so they're going to market around that. Their AI is not as advanced as what OpenAI is able to offer at this point, or Google Gemini. That's why they're partnering with OpenAI on integrating ChatGPT into a chatbot inside of the iPhone experience. That's why they're still talking to Google Gemini and Anthropic about integrating their large language models into the iPhone as well.
Go ahead, Carol.
Well, the one thing I was going to say is I'm a real observer. It's just kind of who I am as a personality. So kind of slow and steady sometimes, but slow and steady sometimes wins the race. And do you feel that way with Apple, that you're okay that they're kind of slow going? I mean, right, we often remind everybody they weren't the first out with a smartphone, but look at where they are today. So how you understand this company, how it fits into the broader kind of bigger tech world, if you will, slow and steady, okay for you?
Carol, here's the difference. You're right that Apple's typically not the first to a new product category, but they're also always the best. The iPhone wasn't the first smartphone, but it blew everything before it out of the water. You saw the same thing with the iPod before it, the iPad after the iPhone. You can even say the same thing about AirPods for earbuds and the Apple Watch for smartwatches. You saw nothing today that's better than the competition. You saw nothing today that's different from the competition, except marketing and a focus on privacy, right? So that's the difference here. They're not the first, but they're also not the best, and they're not the most advanced. They're here extremely late, and they showed up to the party without a gift, right? They didn't bring much new to the table here.
Who's doing what they want to be doing, Mark, but better right now?
Well, Google, OpenAI, Samsung's AI features were pretty impressive with the S24, and Apple's are pretty much in line with that. Now, the interesting part is they've really teased that this is going to improve and get better over the next year or so. So we could be having this conversation 1 year from now, and the Siri features and the AI functionality will be so much better than it is today. Right now, this is also only starting in US English. So there's a lot of market improvements they're going to need to make to roll this out as well.
Hey, Mark, Gil Lorio over at D.A. Davidson made the point to us a little earlier about the, and he cited your work over the last few weeks, about the iPhone 15 Pro supporting the new features. And he said, this was before it was announced, a little over an hour ago, this could be like a moment with the iPhone, the 5G iPhone back in, I think it was it the 12, Mark? The first iPhone that did 5G. Sort of the precedent for a big upgrade cycle as a result of a piece of hardware that is not backwards compatible, software that's not backwards compatible with older hardware. Did we see anything today that prompts people to go out and buy a new phone, even if they have a 14 or not a 15 Pro, that will get them to buy new hardware?
Well, I think when they announced the iPhone 16, clearly their central marketing point on the devices this fall is going to be the AI features, right? The AI features are going to come out alongside the iPhone 16. So if you want these AI features, you're going to have to get the 16 unless you have a 15 Pro already. So I definitely think that this is going to be a huge sales point, and it's going to spur an upgrade cycle for sure. People are going to want the AI features.
It's interesting. Like, I'm looking at our live blog, and just, we take, after months of mystery over Apple's AI strategy, it took a step taken by nearly every other tech company: integrate some OpenAI models into your products for features like text generation. To me, it just is like, all right, everybody, you want to think AI, you got to keep thinking about OpenAI. Like, that is the leader. That's the company that everybody wants to, kind of play around with. I don't know. Like, as you look at AI and Apple going forward, is it something that they can innovate on their own, or they've got to partner along with others at this point?
For now, they have to partner with others. The hope internally is within a few years they could, do this entirely on their own. I anticipate that happening eventually. They need to get their large language models up to snuff. The future of the company and the future of their hardware really depends on it. So I certainly expect them to upgrade their AI capabilities over time and move away from these partnerships.
There's more stuff this week, as we were just talking with our Scarlet Fu, and she's like, it's a whole week-long thing. Is there anything more that you are focusing on? There's more to come, or this was really kind of the big deal?
Well, it is a whole week thing, right? But the rest of the week is labs and classes for developers to integrate the new features and APIs into their application. So there's no more news coming.
Okay, so in terms of the news that already came, what is it? Again, this is Mark. This is the Worldwide Developers Conference. I mean, I think it's fair to say, typically, with maybe the exception of last year when they unveiled the Vision Pro, typically this is really geared toward developers, and it doesn't necessarily make a ton of news outside of the developer world. What do you think we'll see from developers who are going to, take advantage of what Apple's offering in terms of tools to them?
Well, I think developers are going to be curious how they can integrate AI into their applications. What sort of frameworks are going to be available to sort of AIify their apps? Will they be able to use the new writing tools? Will they be able to use the new image generation features, right? And the answer to many of those questions is yes. And we're really looking out to see what types of new applications will be enabled by Apple rolling out these AI features. I certainly think that there's going to be a wave of new AI apps. There's not going to be an AI app store, as some have said, but Apple's here integrating AI heavily across its ecosystem, and that's a positive for the market.
Okay, speaking of the ecosystem, I mentioned Vision Pro. It's been out. It's been announced for a year. Did we get updates on Vision Pro today?
Yeah, so it's going international, as we've been expecting. The new Vision OS 2.0, there wasn't a lot to it. Some new gestures for opening Control Center and opening your home screen, some upgrades to some of their applications. You can AirPlay content into the Vision Pro, some new environments and the ability to see your keyboard while typing if you're using a physical keyboard. That's all exciting. Nothing breakthrough. All a bunch of little catch-up stuff.
All right, I have two last questions for you. Your story that's out on the Bloomberg, which I highly recommend everybody check out. This was kind of the setting up, but also the post. But it initially said Apple event will show whether it can be a force in the AI industry. Can it? Did you get that? Did they show that,
Well,
Mark?
It can be a force in the AI industry with the right partnerships, and they made the right partnerships. And with the right applications. And with their new frameworks, they're hoping they enable the right applications. So I'd say the answer is unequivocally yes.
All right, last question. You're sitting down with Tim Cook. What's the number one question after today's event?
What's the number one question for Tim Cook?
Yeah.
Where are all the other breakthrough new features? How are you going to get people to really buy these phones? Where's the shakeup to iOS? I mean, we're getting Apple Intelligence, but the overall operating system still feels a little stale.
Carol, I'm going to wager that Tim Cook probably has a lot of questions for Mark Gurman based on Mark's reporting over the years.
Can we also ask him, Mark, did he do Apple Intelligence like the Bloomberg Intelligence? Was he looking at us? Maybe took a cue?
No, I think they just swapped artificial with Apple. I think it's just a marketing thing.
Well done, well done. Listen, thank you so much. We know you've been busy in the lead up to this, so good to get some time with you. Of course, he is Mark Gurman. He's our Bloomberg News Chief Technology Correspondent. Be sure to check him out on the Bloomberg Terminal and also at Bloomberg.com.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Remember, everybody, how we keep reminding you that a top risk for this year for investors and really kind of the world more broadly, geopolitics and global elections. On that, after a crushing defeat in the parliament elections yesterday, European Parliament election yesterday, President Emmanuel Macron plunged France into political uncertainty with a snap legislative ballot that restages his perennial battle with far-right rival Marine Le Pen. So we are watching this closely, but there's a lot more going on too.
Yeah, because the election result highlights the increasing rejection of mainstream politics and left the credibility of the bloc's two most important leaders in tatters. Economics and politics, Carol, continue to connect and drive outcomes. They always have, but are today increasingly upending the status quo and the expected and driving a populism wave around the world.
We're seeing it happen in real time. With more on the connectivity of it all, let's bring in Bloomberg News global economy reporter Enda Curran. He is in our DC bureau. Enda, elections around the globe, the rise in political uncertainty, take France over the weekend. Much has to do with global citizens kind of having had enough of the way it is and feeling like they are being left behind. That we are seeing increasingly around the world.
Yeah, absolutely right. As you say, this was, teed up as the year of the elections anyway, and it really is playing out that there is a commonality of voters are resentful and they are punishing their ruling governments, not in every case, of course, but in some of the big cases. We had India last week, and that triggered a big shock in financial markets. Now we had the European Parliament elections over the weekend, that swing to the right, especially in France, triggering shockwaves in financial markets, especially because Macron is calling the legislative elections there as well. So we are now seeing the shock risk of these elections playing out, and a kind of a common underlying theme that people are expressing their discontent with governments, even in cases where, broadly speaking, the economy is doing okay, which you could argue for the case of France and India, markets doing okay, but that's rightly or wrongly not flowing down to people on the ground, and they're expressing their frustration in these ballots.
So where would you say, that discontent is coming from? Does it have to do with individuals' economic situation? Does it have to do with inflation? Does it have to do with immigration? Where are we hearing and seeing in polls the discontent coming from?
Well, if you take France in the case there of Jordan Barbella in the National Rally, the Le Pen opposition to Macron during the European elections, a common theme there was opposition to European trade policy, opposition to European climate policy, and of course a harsher line on immigration, and that of course feeding into discontent among populists everywhere in terms of cost of living and economic pressures that they're under, even as headline economic growth looks okay. France is doing relatively okay versus other parts of Europe. It's a pro-business agenda there under President Macron. It's being seen as somewhat as a reasonable economic performance for France, but obviously that's not translating down to people on the ground. And the same in India, by the way. We all know India is this global star economic performer, one of the fastest growing in the world, an alternative to China for foreign investment. Markets there are booming. Everyone talking about foreign investment going into India, but obviously when we saw the election results, people on the ground unhappy. And I think a lot of it is coming down to these cost of living pressures. And of course you can draw a parallel with India, Western Europe, and some of the mood in the US too.
So I have to say, Enda, when Tim and I were preparing, and our team were preparing for today's show, this hour and really the next 2 hours that follow, we've got Peter Goodman coming up later on. He's global economics correspondent over at the New York Times. He's got a book, How the World Ran Out of Everything, and really goes through some history lessons about kind of obviously what happened during the pandemic, but really how we got to that point where so much was made in one part of the world, China specifically, but also how it was all done on the backs of workers. And basically we got rid of some really well-paying jobs, middle-class working types of jobs, and to jobs that really paid a lot less, and just why there are so many individuals, global citizens, that are feeling kind of left out despite the market growing, the global economy growing, and the wealthy getting wealthier. So, there's another story that our team has put out by Chris Anstey and looks at the Mexico election and talks about a warning. And this looks into the new economy, but talks about populism can sometimes lead to results that damage the very people who are rightfully seeking their fair share. I do wonder the pushback on globalization, the rise in populism, what that might mean ultimately. Do investors look at different markets as investable, not investable? I mean, what's that thinking, and how you and your team are thinking about that?
You're absolutely right. I mean, this goes to the core of why there is such a realignment going on in, if you want to call it, the Western industrialized world. That discontent on the ground that you talked about there, Carol, is forcing governments to either promote more industry at home, pour more subsidies or tax breaks to generate investment at home. They're also looking at shaking up their supply lines for basic goods up to more higher value added goods. So there is a kind of a reshuffling going on around the world to partly address some of these issues. Now, of course, that creates winners and losers, and that's where the investors come into this. The winners are going to be, broadly speaking, the rich world, who can afford to either subsidize industry at home or can afford to shake up their supply lines, and they can attract investment from other parts of the world, and the investors are looking at those rich countries. And then the concern is that the poorer countries, who maybe benefited from globalization in the first place, the emerging world, can't compete on the same level playing field. They won't be able to attract investment in the way they once were. But that said, broadly speaking, there are changes going on in global manufacturing, global supply lines, global investment. But let's just say, when it comes to manufacturing, at least, China and parts of the emerging world still offer a fairly compelling model. They offer scale, they offer cheaper workforces than the Western world. So, this story, while there are changes going on, it still has a long way to go before you could really call an end to globalization as we've known it over the last 20, 30 years, say.
But that's what I want to explore with you, like this idea of the cheaper workforce. We keep lauding it as like, that's such a great thing. We reduce costs, cheaper labor. That means profits go up and shareholders are happy and we can do more dividends and buybacks. So I do wonder, and then yet workers on the ground are saying, man, I can't make ends meet. We're not, because the jobs are just not either as high paying as they used to, or there's so much pressure. And I do wonder economically, this is resulting in kind of the political pushback that we're seeing.
No, it is, because if you want to call it the Western world, for argument's sake, or the developed economy world, they cannot afford the kind of manufacturing, much of the manufacturing that continues to be done in the emerging world and in China in particular, and even where wages are increasing in China, it's still ultimately more competitive to do business there or in Mexico or in Vietnam than to bring it back to, say, the US or Paris, where you've got union laws, you've got minimum wages, you've got all kinds of rules and regulations to pay a living wage. So that competitive edge still very much exists in favour of the emerging world, and you can argue, of course, the rights and wrongs with that, but multinationals aren't in a hurry to bring back those kind of high-paying jobs. But don't forget, other factors are at play too. Automation is going to be a factor in all of this that will see production brought closer to home too in the years ahead.
Hey, and I'm wondering if we can look to the results that we've seen in recent weeks with global elections and perhaps read into the future of our country in the US here, our country, the United States, come November. Is there any way to sort of look at what's happened around the world and get an understanding for the way that things are moving come November?
Well, it's obviously idiosyncratic, Tim. Everyone has their own story, their own gripes, their own complaints. But you'd have to say, on the surface at least, even where countries are having a pretty good run economically, at least on a headline basis, strong growth, strong investment, strong markets, that isn't necessarily translating into a happy mood among voters, and that's creating discontent at the ballot box. That's showing up in the polls in the US, for example. People are citing economic unhappiness and inflation. So that's one corollary you could draw with them. And then more broadly, it's a tough time to be an incumbent. Look at the UK election. Yeah. Look at France, look at India. There's pressure on incumbents, no doubt about it.
Yeah, I was just going to say, Carol, when Enda was talking about the Bloomberg News Morning Consult polls of swing states that we've done here at Bloomberg News,
right,
about the fact that many voters in these swing states do think that Trump will lead better when it comes to the economy.
Yeah, it's kind of interesting considering kind of the economic backdrop, but that's politics, and it makes it always very interesting. And as we've seen from some of the global elections, a bit unpredictable, to say the least. Edna, thank you so much. Covered what we were hoping to do on this Monday. Bloomberg News global economy reporter Enda Curran.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, Carol put this on my radar a little earlier. A main feature of the 2024 labor market is that fewer people are quitting their jobs. A lesser known one, we knew that from the JOLTS data and the quits rate, right? Mm-hmm. A lesser known one is that fewer are actually getting promoted.
It's really interesting. So that leaves little room for new workers to break through as the ranks of employees above them are staying in place. And it makes it more difficult, Tim, for young graduates to get their foot in the door.
We've got back with us Jane Oates, Senior Policy Advisor at WorkingNation. It's a media company that focuses on the future of work. Jane, also former Assistant Secretary of Employment and Training in the Obama administration. She joins us from Arlington, Virginia. Jane, how are you?
Hey, Tim. Good. Nice to be back. Hi, Carol.
Hi.
Yeah, it's good to have you back with us. Hey, I just want to start with the blowout jobs number that we got last week. It came in above all economists surveyed by Bloomberg expectations. We get that. And then still, based on surveys, people are not happy with what they're doing at work, and they're not happy with the economy. What's going on?
Yeah, look, obviously the economy's tightening slightly. It couldn't stay where it was, with 3 jobs for everybody looking. So it's tightening a little bit, but I think as usual, you two follow the information trail. People are not moving. I mean, we saw all that stuff 18 months ago about people quitting, and people are not moving now, and it's creating a real logjam. We have 4 million people leaving college this time of year, and another 1.5 million leaving high school, and that want to go right into the workforce. It's going to be tough for the next few months.
I don't get it. It's just kind of wild, right? Like, we talk about a tight labor market, people need workers, and yet, right, it's just these weird kind of, I don't know, cross currents. It's hard to make sense to some extent about what really is going on in the labor market.
I mean, look, Carol, some of it's geography. There are all these jobs open, but they're in places where there aren't people looking. Some of it's a skills mismatch. And some of it, I have to tell you, I like to blame the automated software that's looking at resumes. I think that businesses are missing a lot of talented people because whatever they forgot to put in their cover letter and on their resume isn't matching the language in the job description, so they're not getting the job.
But does it work both ways?
Spoken to.
Does it work both ways? I was talking to somebody who was doing some hiring ahead of intern season, and she told me this is a shocking number. There are basically 30 places for interns at the organization that she works in. They got thousands of applications, Jane, for those 30 spots. And I'm thinking to myself, how are you getting so many applicants? Are people just doing this automatically? Are they sending, how does this work?
Yeah, I mean, I think people are really interested in this paid internship thing. They realize that it's work-based learning at its best because they don't make a long-term commitment like in a registered apprenticeship program, but they're able to get in, see if they like the employer, see if they like the work. So it is really hot right now to get a paid internship, an internship of any kind, but most people need the salary to go along with it. But I understand. I mean, I like business too much to hound on them, but
Yeah.
I do think, I know how cumbersome they have to keep their business going. They don't have time to look at thousands of applications for 30 open internships. You're right, Tim. I get that.
All right. So I don't know, what's that? It's interesting. One of the things I keep saying, and forgive us, audience, because I keep talking about Peter Goodman, his new book out, How the World Ran Out of Everything. And, I keep thinking about the future workforce because it seems like globalization has really, increasingly gotten rid of middle class, well-paying jobs that really allowed people to have a good life, buy a home, support their family, go on vacation, and that we've kind of gotten rid of a lot of those jobs in the middle sector, if you will. And I do wonder kind of if we're not, fertility rates are low, people, where's the future workforce going to be? Is it going to be robotic, automated, AI? I'm trying to understand kind of where this all goes ultimately.
Well, AI is going to influence every job that's out there. And it's also going to influence.
But how? We keep saying these big, broad things about AI, Jane. I'm curious how you see specifically that AI, which has been around for decades and already impacts our world, how the next generation of AI and large language models and so on really change significantly the workforce.
So there's going to be some immediate changes that are easy to see and some that are less easy to describe. But let's look at PR firms, right? PR firms used to hire lots of people. Junior staff people would come in. They'd write the first draft of something for a customer, and then somebody more senior would edit it and finesse it because they know the customer better. Right now, people are using generative AI to do that first draft. So you see real slowdown in hiring. You see a real problem in coding. AI can write code faster than any human. And basically all those people who went to coding camps 10 years ago are looking at a very limited shelf life right now. Those are two easy examples.
Isn't it amazing how we were telling everybody, hey,
learn to code.
Right.
Go to boot camp.
Go to that coding school.
Yeah.
Right.
Okay, so let's leave it on this last question. What should we be teaching our kids? We have about 30 seconds left.
Yeah. What kind of should they go to college? What
prompt
kind of degree
school.
should they get?
Prompt AI prompt school.
Prompt engineers are getting laid off now, Tim, too, because people realized you didn't have to have that title. But, uniquely human skills, all the things that we've been talking about as employability skills, learn to problem solve, critical thinking, learn to work in a team,
Sounds like a liberal arts education.
I was just going to say that. Finally, my history degree gets put to good use.
Remember when liberal arts actually was?
Yeah.
With some data analytics. Put some data analytics skills in there.
All right.
That part I don't have.
My daughter's kind of doing this kind of stuff. All right.
Good for her.
Good stuff. Yeah. All right. Jane Oates, thank you so much. Senior Policy Advisor at WorkingNation, a media company that focuses on the future of work. She was a former Assistant Secretary of Employment and Training in the Obama administration.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Carol, our colleague Jarrell Dillard, reporting last month that 3 years after pandemic-era funding led to a boom in Black-owned businesses in the U.S., the cohort of entrepreneurs seeking to expand is facing the same barriers to capital that hampered generations of owners before them.
Yeah, we've seen this movie before. In 2023, just 32% of Black owners were fully approved for a loan or line of credit compared to 56% of white entrepreneurs. That's according to a March report from the 12 regional Federal Reserve banks. Black owners, Tim, were also more likely to have to use personal funds to address financial challenges. So tapping credit cards and things like that.
Yeah, one organization trying to address this is Momentus Capital. It's a nonprofit, and it just announced a $171 million fund to invest in small businesses that are creating social impact in underinvested communities. Yrenilsa Lopez is Managing Director of Investments at Momentus Capital. She joins us from Brooklyn. Yrenilsa, good to have you with us this afternoon. I think the big question I have is about the structure of the organization, because when we talk about companies or bodies that invest in other companies by providing capital to them, so much we talk about is in the for-profit space. Give me some details about the structure of Momentus Capital that allows it to be a nonprofit that makes these type of investments that's looking for return.
Certainly. So Momentus Capital is a brand of organizations which include mission-driven lenders. So it includes capital impact partners and includes CDC, small business lending. And these organizations have over 40 years of experience lending to small businesses and also operating in the underserved community space. And so when we speak about these organizations, yes, they are a nonprofit. However, our fund, the Equitable Prosperity Fund, is actually a third-party fund that we came together alongside aligned investors. So we have over 20 limited partners that make up this fund, which does include Momentus Capital. But it also includes our aligned partners from many years and also some new partners. So we have financial institutions, we have high net worth individuals, family offices, corporations, and also charitable foundations. So it's sort of a blended capital structure, which exists as its own fund. That's a $171 million fund. And that's the fund that is able to make these private investments into these small businesses.
And talk a little bit about the expectation, at least timeline for returns here. We're talking expectations are 3 to 5 years to see a return?
Those are the individual investments and how they're structured. Yes.
Okay.
The fund itself is your standard run-of-the-mill 10-year close-ended private equity fund. The way which we structure it with our investors. Each investment as a whole is structured to be along the 3 to 5 year. Nothing's written in stone, but that's where we have found where we can provide growth capital in an adequate amount of time to also at the same time liquidate and provide the return to the investor, while at the same time the growth capital itself can be used to grow by the entrepreneur.
Explain the type of capital that you offer. You said growth capital, but you also say it's non-dilutive. So does that mean you're giving loans to these companies?
Yes, actually, that's a great question. It's a question we get almost every day. And so the nexus, the reason for this fund is because we have found, and again, the over 4 decades of experience, is that entrepreneurs are oftentimes, the structure of a traditional debt instrument is often lacking for some of these entrepreneurs that don't fit the mold. Either it's a personal guarantee, collateral-based, fixed payments, and payments that don't align with the business's specific cash flows. On the other hand, you have equity. And then you have equity where you imagine you're an entrepreneur, you've built your business, it's a family business, and then you sort of have to give a piece of it to a new institutional capital provider. So our instrument lies somewhere in the middle. So it's much more patient capital. It's revenue-based repayments, profit-based financing, meaning we are taking the growth risk alongside the business. And so we structure our investments so that it's a revenue-based sort of repayment structure, so that if the business requires maybe a couple of years for that capital to really begin to leverage in returns, we're there with the business until it does begin doing so. And then we don't take any shares. We have no ownership stake. We have a preferred equity stake. And so what we try to do is we try to give the best of both worlds. And so it's not a traditional debt structure where there is no personal guarantee, there are no collateral, no fixed payments expected. However, we're not there forever. We have a structure that is self-liquidating in a sense. So we also hope for our own investors' sake to provide them that liquidity that also your traditional equity investments don't provide, which is oftentimes a very heavy back-ended exit risk.
Yrenilsa, would you say that would it be fair to call it sort of in the private credit universe?
Yeah, what do you call it? It's definitely a payable, right? It's certainly a payable, yes. I would say we'd like to say it's an instrument. Well, we don't like to call it a loan, because ultimately it's an open-ended redemption period. The redemption period is defined by when we do receive these returns. So if it takes the company a little bit longer than that 5 years, that's just the way we structure the instrument. So we are there to make sure that we benefit and we are repaid when the company is in fact doing well with our capital.
So just so that I understand, so then what's typically the return to investors, and then what's the cost to those that are borrowing or partnering up with you and getting the infusion of capital?
Yeah, the return we're targeting, it's a market return. So we are targeting commercial returns. And I would say, without getting too specific, of course, for our investors, and the cost is somewhere along between I would say, subordinated debt and equity sort of expectations. And the reason for that is because of the highly subordinate nature of our instrument. What we want to do with the instrument is not just provide the capital, but also crowd in additional capital that may be needed. So the use of our funds is for growth, but ultimately these companies will similarly have working capital needs or just other continued funding needs. And so we're not there to take up any sort of asset claims or collateral claims.
Yeah.
And so what we would like to do is have other lenders look at the company and say, well, we have some level of comfort that there's this institutional investor in there. And also that they have become subordinate to any senior lending. And so we're there to provide senior lenders with some comfort. And so you can imagine the risk return profile of that being somewhere in the middle.
Give us an idea, we've got about a minute left, of some of the companies that you've invested in. What's the typical size that a lender or borrower, needs? Give us an idea. And what type of businesses are we talking about?
Yeah, so we would like to target investments, particularly that serve underserved communities, but particularly we're focused on improving access to healthcare and improving access to healthy foods. So one of our investments is a healthy food distributor that works with diverse farmers in Virginia and distributes healthy foods to underserved populations in Washington, D.C. So that's one of our investments. Another one of our investments is a medical imaging company where our growth investment was used to grow and develop a telescan for maternal health screenings in healthcare deserts. So the typical size of our investments tends to be between 3 to 5 million, which does translate to companies that would begin with maybe a $4 million revenue size.
Do all of them survive? Just got about 15 seconds. Do they make it?
Yes. I mean, listen, our portfolio is healthy today. We just closed, but we have about 2 years in. So our portfolio is doing well so far.
Yrenilsa Lopez, Managing Director of Investments over at Momentus Capital, joining us from New York. Thank you so much.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. Just about 13 minutes left, just under 13 minutes left in today's trading. We've got equities near just off their best levels of the session. And you heard Charlie breaking down some of our focal points. You've got yields. Certainly, they have moved up coming off of that Friday jobs report. So that's kind of our backdrop, macro backdrop, as we are counting down less than 48 hours away from the next Fed decision.
What are you going to count down after that?
I don't know. You know me.
Yeah, you'll find something.
Earnings.
Okay, that's what it'll be. Hey, that chuckling you hear is a polite chuckle from Carol Schleif. She's Chief Investment Officer over at BMO Family Office. She's here in the studio right now. Good to see you. How are you?
It's great to be here. It's lovely to be in New York. I love the energy.
Good. What do you think of it right now?
I love the energy. And actually, I was astounded at the airport last night in Minneapolis.
LaGuardia?
It was, no, Minneapolis. Oh. It was so busy. And every airport I've been in, except for Milwaukee last week, every airport I've been in has been packed. Every plane's been packed. So it's positive for our year-end expectation that we actually see the economy firmer by year-end.
So are you using that anecdotal data to sort of inform the way you're thinking about the economy?
I think it helps contribute, but so do conversations with our commercial bankers, so do conversations with my clients who are still active business owners in a variety of different parts of this economy, from basic manufacturing. So they're impacted by tariffs, they were impacted definitely by trying to get imports in through the ports, we've got all kinds of stuff.
Okay, so like I said, our audience is going to hate us at this point because since we've been on air since 2 o'clock, all we keep talking about is this book by Peter Goodman, How the World Ran Out of Everything. But it really taps into globalization and kind of where we are. And then it kind of gets into why a lot of workers don't necessarily feel good because either their jobs, they don't have them anymore. They were good paying jobs. Take the auto industry, and then maybe that's why you see some of the political polls or elections globally play out like they are.
Exactly. There's such a disconnect because, back from decades ago when we were all reading about the world is flat and the globalization and all the FP&A departments were telling everybody to outsource.
Right.
And thinking and forgetting about the second and third impacts of that, which is where, if the consumer decides they like blue, not purple, then it's months and months and months to get it back over here. And there's a lot of people that got left in the dust. And I think when you look at the Harris poll in terms of the people that think the market's down.
I can't stop talking about this Harris poll.
They think the market's down.
What do you do with that?
I think the biggest thing we do with that is we get younger people engaged, and because you've got two different contingents. You've got the baby boom driving politics, but you've got millennials and Gen Z, which are bigger populations together, all turning 35-ish,
right,
wanting to buy homes, which they can't afford, without a cosign by mom and dad, and they can't pay off.
So you cosign on the school loans, and then you cosign on the house, and then you it's kind of crazy.
Yeah,
I just want to jump in real quick. If people don't know the Harris poll that I'm talking about that Carol just mentioned, it's a Harris poll for The Guardian shows that 55% believe the economy is shrinking. It's a troubling sign.
Markets are down.
Yeah, 49% believe the S&P 500 stock market index is down for the year, though the index went up 24% last year, and it's up more than 12% this year. This was as of May 22nd when The Guardian came out with this. And 49% believe that the unemployment rate is at a 50-year high, though the unemployment rate has been under 4%, a near 50-year low. This, again, coming from The Guardian. They teamed up with the Harris poll last month for this result.
And it's because so much of the population has been left behind in that outsourcing, and now we have a shot at bringing some of it back here in terms of manufacturing, infrastructure. One of the interesting anecdotes I picked up is that muni bond issuance is the highest in the first year to date as it's been since the early 2010s.
Interesting. Because stuff coming back and needing to build things out.
Yeah, which means schools, roads, bridges. And so if you're pulling the funds in the last 5 months, that has yet to be put into the ground or people hired to build those. So, a lot of our basic jobs, we have to rethink our economy in general, because you've got AI on the one side, but we also have huge need for welders and electricians and skilled workers to run the plants that we're going to have, because these aren't going to be these aren't going to be our grandfather's manufacturing plants. They're going to be new manufacturing plants with fewer tech-enabled people.
So what does that mean? Like you mentioned, you've been talking to commercial bankers that you work with, business owners. What do the business owners say about, how if we are doing more things, our supply chain back home, it's going to be a more expensive supply chain, I would assume. So when we think about that cost side to their equation, trying to run profitable businesses, and I think on the public market side of things, where investors care about things like buybacks and dividends, the cost equation changes. Like, how does the investment environment change, perhaps?
Well, the interesting thing is if you look at a long-term chart of margins, they're coming off of historic highs, and they've been at highs for a very long period of time. These aren't the margins we had when we were a manufacturing dominant society.
Benefiting by globalization.
Yeah, exactly. Well, benefiting by globalization and technology.
Okay, fair.
And so to the extent that we can get AI in there and figured out how to work smarter in those factories, in the long run, our suspicion is that margins don't have to be too hit. In the short run, it's tough to be a public company as opposed to a private company, because a private company, you can do those sorts of investments, rearrange your business, and then go public if you want, once you've done that. But it's tougher because investors do demand that quarter to quarter.
Yeah.
So we need CEOs, actually, if they could get together and say, no, here's our long-term vision, because a lot of countries, you take a country like China that can plan for the long term and trash earnings.
Well, we know shareholders are notoriously patient, right?
Well, see, that's the thing. Like, I do wonder. First of all, Tim and I keep hearing where there's so much money in the private markets that it's like highly recommending younger companies to just stay private because they can benefit. So then it makes me wonder, from what we do on a regular basis in a big way is cover the public markets. Right. Makes me wonder about like the future of the public markets.
Well, I suspect you'll get you may not have a 95 to 2000 kind of a rush or a 1982 to 83 sort of IPO boom, but I would suspect sooner or later even that most patient capital gets itchy in good markets to see it out. We'll see the test, because the so-called IPO window is hopefully opening. Yeah. We're wishing it would open and ready to do
Private
deals.
Equity folks would like for it to open.
Yeah, and
there's some signs that it's opening a little bit.
There are, and I mean it all depends on if you can get those deals out and they generate more deals. I mean, investors are anxious for that to happen.
Do you want to ask about, can we ask about Apple? Do you have a thought?
Yeah.
I know I don't know how specific you can get and drill down, but we've been focused on Apple AI. There's still one of the largest market cap companies. I don't know. Is there a technology thought? I don't know where you want to go and how specific you can drill down.
Well, I think the interesting thing is like everyone wants to know what exactly this is going to do for me and how excited it's going to get. Did I know I was going to become addicted to my iPhone before they introduced it? No, I mean, I want that sort of sizzle.
I thought it was just for phone calls.
But I also do want, and I was listening to you earlier, and I saw those same memes go through my Instagram, because I actually have trained my Instagram to feed me funny stuff to make me laugh at night.
That's good.
But
maybe we should all have that.
The meme about please unload my dishwasher and do the clothes, not paint my pictures and write my music and do that stuff. Right. But we want something like that. But I also want something to organize my day, and totally to the I need to arrange for 12 people to Mexico next spring. You sit on the phone and figure it out and get me the room I need.
Okay, but it's funny you say that, because we only have about a minute left, that we're all addicted to our phones, but we're also all probably trying to use them less.
I'm trying to use it strategically.
Yeah.
In terms of there's certain things that I have on because it's the only way I get pictures of the grandkids or invites to their birthday parties. Yeah. And then there's other things in there that I train there specifically because I don't hover over certain things and I do hover over other things to train it to make me laugh. So.
Yeah, I actually put it down. On the charger, especially on like weekends, unless I know that I've got something work related or something, and it's not that my family, usually I'm with most of the family that I most care about.
Yeah, you have to be very intentional about it though, because there is that addictive component to it.
I think she set up a filter for my text messages, because when I text you, Carol Masser, I'm surrounded by Carols right now, so I have to,
Tim is always like, check your phone, check your messages.
I'm like sending her an email, check your texts, or sending her a text, check your email.
Oh my God, it's complicated.
Just love, Carol. Carols, all love.
All Carols are great. I'm just going to put it out there.
There you go.
Really fun to have you in. I hope you enjoy your time in New York and look forward to next time.
Great to be here. Thanks for having me.
Carol Schleif, she's Chief Investment Officer over at BMO Family Office, joining us in our Interactive Brokers studio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.